All right, let's talk about one of the most frustrating parts of trading. You know that feeling, right? Like you're just stuck in a loop, making the same costly mistakes over and over again. Well, today, we're going to break that cycle, starting right now.
I mean, does this sound familiar? You've got a solid plan, you know the rules, but somehow you still end up taking that impulsive trade or bailing out too early. What if the real problem isn't your strategy at all? What if it's just where you're putting your focus?
You see, the real issue isn't the market. It's our focus. We are just hardwired to obsess over the immediate result. Did I make money or did I lose money? And that, right there, is the very thing that's keeping us trapped.
And this brings us to two completely different mindsets. On one side, you've got outcome-based thinking. It's all about the P&L, the profit and loss. And that just breeds fear, greed, and a ton of inconsistent actions. But on the other side, you have process-based thinking. And here, only one question really matters. Did I follow my plan? This simple shift is what moves you from luck to skill, from emotion to execution. And that is the absolute key to consistency.
Okay, so how do we actually make that shift? We need a system, a real system to break the cycle. This is where we're going to learn why your profit and loss statement might just be the most misleading teacher you've ever had.
The solution is to start treating trading like a professional performance sport. I mean, think about it. Top athletes don't just walk off the field and forget about the game, right? No way. They go back, they watch the tape, they analyze every single play, win or lose. We need to do the exact same thing with our trades.
And it all starts the second you close a position. This isn't something you put off until the weekend. We are talking about the crucial first 15 minutes, while that trade is still completely fresh in your mind.
So here's our game plan. It's a simple 4-step postmortem for every single trade. We're going to document, we're going to analyze, we're going to assess, and we're going to check. Let's break down exactly what that means.
First things first, you've got to get the objective facts down. No opinions, no stories, just data. Your entry, your exit, the time, the size. And crucially, you have to capture annotated screenshots. Why? Because our memory is tricky. We tend to remember trades as being way better or way worse than they actually were. Screenshots don't lie. They create that unbiased record you need for real analysis.
Next, we analyze the execution. This is where we separate the plan from what actually happened. Ask yourself, did I enter precisely where my rules told me to? Was my stop loss in the right spot? Did I use the right order type? A winning strategy can easily fail because of sloppy execution. This step is all about tightening up your game. And now for what might just be the most important step of all, assessing your emotions. You have to be brutally honest here. Were you feeling anxious when the trade went against you? Did greed start tempting you to move your profit target further and further away? Write it all down. By journaling your emotional state, you uncover the patterns that lead to those impulsive decisions, and you build the self-awareness you need to keep emotions from hijacking your plan.
And finally, you got to step back and look at the trade idea itself. Was your initial analysis sound? Did the market actually confirm your idea, or did it pretty much invalidate it right away? This helps you figure out if you just had a good idea that didn't work out, which happens, or if your initial read of the market was just flawed from the start.
Now, after reviewing individual trades all week long, it's time to zoom out. The weekly deep dive is where we stop looking at the individual trees and start seeing the entire forest. This is where you truly discover your statistical edge.
And to find that edge, we need objective numbers. Let's look at 3 crucial metrics. Win rate is simple enough. How often are you right? Profit factor measures how much bigger your wins are than your losses. But expectancy, that's the holy grail. It combines the other two to tell you, on average, exactly what you can expect to make or lose per trade. That number is the mathematical proof of your edge.
So what's the whole point of all this data? It's about finding patterns. You're looking for what your best trades have in common. Is it a certain time of day, a specific market condition? You use that information to make smart, data-driven tweaks to your strategy. And, just as importantly, to identify and work on your own discipline issues, like revenge trading or FOMO.
Okay, I know we've covered a lot, the immediate review, the weekly review, but how do you tie it all together into a simple daily habit? That's where the 3M Mastery Framework comes into play.
The 3M framework basically distills everything we've talked about into a simple daily habit. It's a fast, powerful way to evaluate every single trade, forcing your focus onto what truly drives long-term improvement. The first M is mark. After each trade, you're going to grade your performance from 1 to 10. But here's the twist. The grade has nothing to do with making money. It is purely about your execution. A perfectly followed plan that ends in a loss, that's a 10 out of 10. A sloppy, impulsive trade that got lucky and made money, that's a 3. The second M is measure. Instead of thinking in dollars, you measure your trade's outcome in R, or risk multiples. So if you risked $100 and made $200, that's a plus 2R trade. If you lost, it's a negative 1R trade. This standardizes your performance and lets you compare every trade on an equal footing, giving you a true measure of your strategy's expectancy. And the final M is master. This is where everything comes together. Based on your mark and your measure, you identify one and only one specific, actionable thing to master on your very next trade. Not make more money, but something concrete like, I will wait for the candle to close before I enter, or I will not move my stop loss once it's set. This creates a powerful cycle of continuous improvement.
So, what does this all lead to? It leads to a fundamental shift in your identity as a trader. You stop chasing profits and you start mastering your process because you finally understand that your process is the only thing you can actually control.
You have to internalize this core idea. A good outcome doesn't mean you did the right thing, and a bad outcome doesn't mean you did the wrong thing. The market has a degree of randomness. Your only job is to focus on perfect execution and let the probabilities of your edge play out over hundreds of trades.
So I'll leave you with this question. Forget about profit for a moment. Think about your last few trades. What is the one specific, controllable action, the one piece of your process that you will commit to mastering on your very next trade? Because that is where real progress begins.